Avinash Singh, Senior Analyst Insurance and NBFC at SBI Capital, joining in on the show right now. Avinash, hi, morning. Most life insurance companies like ICICI Pru, SBI Life are trading below IPO price except for HDFC Life. What's led to this kind of impact on valuations?
Yeah, hi, morning. Yes, you are right. I mean, most of the stocks, are trading almost in the last 12 months. They are down anywhere around 20-25%. And in the same period, if you see, their intrinsic or what embedded value, of course, it would have grown by anywhere between 15 to 20%. So yes, when it comes to the multiples have seen a sharp correction, and almost in the last 1 year, you would have seen multiples just coming off by say 30-40%, because the two factors that your embedded value is growing and your prices are coming down. There have been different concerns regarding different stock, and also some concerns, as Poonam just told you, regarding what is happening with the sector. But to be fair, if you see how the companies have delivered over the last 12 to 18 months, since their IPO, is there a major surprise? Honest answer would be no. It is just that, okay, perhaps the perception of investor have changed a lot during this time. So if you were to look the kind of growth even so far, iPro is exception for its own reason. But if you look at the other private players like SBI Life, HDFC Life and Max Life, overall private life insurers have sort of grown in the retail business closer to 11-12% in the first 9 months. Now, this growth coming on the back of 2 strong years of growth, is it really bad? The answer would be no. But perhaps, investor would have extrapolated or expected a 20% plus growth to continue for many years. Given the nature of your business, particularly that a large part of your premium is coming out of savings product, that by nature is a sort of a cyclical and seasonal. It also compete with other investment or saving avenues. So when the bank's interest rates are sort of going up, deposits also become attractive. At the same time, you have other alternative. It is not as if, so the protection is the only piece where you don't have competition, but saving products compete. So in that background, the growth is not really slow. If you see their VNB margins, margin expansion has been gradual. So broadly, you can say that margins are staying where they were or slightly improving gradually. But that gradual improvement has continued and will continue, because you will still continue to see your protection in the product mix improving. So if you on a balance, if you look at the growth versus the quality of your that growth, it is not bad. It has been reasonable enough, except for one or two companies. So overall, your growth has moderated, and for obvious reason that, okay, that high base, that high growth cannot sustain for very long. So your growth has moderated, but at the same time, your persistencies are holding up, your margins are gradually expanding. So in a nutshell, your value you are creating, your value of new business growth, that remains very healthy. For most of them, close to 20%. So yes, it has been more of a case of derating or sector going out of favor rather than really fundamental changes explaining this fall.
Okay, the note band saw high growth for life insurance companies. 93 saw APE growth coming down versus FY18. What is the outlook ahead in terms of the overall growth numbers? And also, if I could just tie in one more question, from a valuation standpoint, what would be your top picks?
Yes. Growth outlooks, look, over the medium term, we still expect the growth to come back around the 15% odd level. That is very much sustainable medium term growth in the Indian context. Whereas, the 15% kind of a growth for APE is what we expect, but your VNB growth will be slightly higher, because your margin expansion story will continue, because within the product mix, your protection will continue to grow faster, because on the protection front, we have just scratched the surface. A macro, India remains a highly unprotected society, and protection products have, particularly on the individual space, have just taken off, and this strong growth in protection will continue. That will help the companies to improve their new business margin. As a result, your VNB growth, absolute VNB growth, should be higher than this 15% APE growth over the medium term. As far as our pecking order is concerned, our pecking order is a combination of factors, that is basically the franchisee strength, growth outlook, and of course valuation comes as a another parameter where we need to have comfort. And in that pecking order, we have SBI Life remains our top pick. I mean, barring the uncertainty around that stake sale by the promoter, the growth in terms of the longevity of growth is very much there. I mean, they have started their journey in the large customer base of SBI, and of course that remains. Beyond that, of course, they have started to do a lot on protection. So our pecking order is largely SBI Life, followed by Max, followed by IPO, and SDFC Life, of course, very strong franchise, but the valuation even after this correction leaves very little room for an upside.
Okay, Avinash, great to speak with you and try and understand what's really going on in the insurance space, and good to get in your recommendations as well.